Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, all. Ira Epstein of Linn Associates with your agriculture update, and we are now on Tuesday, tax day, April 17th, 2018, and we're around 4:56 p.m. Central Daylight Time, and it's the reason I'm not taking you to these boards behind me because they clear them as we do this. I'm just late. I had a lot of television interviews today, Canada, Australia, doing different ones for different places, plus on the phone, so it gets a little crazy. But in looking at the market, I'm still saying the weekly area chart of soybeans is still bullish. We had a meeting this morning, and I was asking in the meeting, what happens now that Argentina's had this drought situation if the U.S. has any problem in its soybeans this year? Now, please understand, beans get planted very late typically, so we're not even close to that. Groundwork in much of the Midwest is behind because we keep getting so much snow. Cold, you know, the planting is going to be late, but we always seem to catch up. I've been at this 45 years. You typically catch up. But you do get years where people look at it, and I asked, what is the common thing that we're seeing some people do? And they're saying, we have seen a lot of people just buying out-of-the-money calls as an insurance policy in case something happens. It's throwaway money. They might buy one call, write another one, even further crazy out, because you don't know what could happen. It's just what I'm saying. If we are only at April 17th to talk a U.S. weather market on this date, but you should talk about it to think about it for your needs. If you're a farmer or somebody else out there, what do you do? And you always, if you're a user, whoa, you've got to make sure that you're protected in some way, because when that one thing happens that you didn't throw some money away on, you get very sorry very fast. So in looking at the market, you're still in an upthrust. On a closing basis, you've stayed over the 18-week moving average of closes. When you just look at the chart, you spiked up here. You have fallen back about 30 cents. We can see that from 10.78 down to a low today of 10.51. So I'm wrong. It's 26 cents. Sorry. But you don't have a pattern to trade. You've got a lower low and a higher high. We're in a corrective mode after moving this market from under $10, nearly up a full dollar, and the market is giving back a little bit of it. If you put Fibonacci numbers on, you might get another type of count. I might do that on one of the charts this week. But where the market might find support is the 18-day average of closes. Why? Chartists like neutral points on a chart. They want a reference point. You will hear, if you watch financial TV, the 50-day moving average on stocks, the 200-day moving average, over and over. Futures are a little different. By their own nature from stocks, they what? A futures contract expires. A stock only goes away if the company gets bought out, goes out of business, or closes for whatever reason it might be. Mergers, acquisitions, there's many things that can happen, but they don't expire on their own if the business is good. Staying in business, not a takeover, and nobody wants to shut it down. Well, that's not true on a futures. No matter what's going to happen in July beans, I promise you, in the month of July, it's going to expire. It's going to stop trading. And that just changes the nature of all this. Of course, in futures, you get very good leverage, high leverage, whereas in the stock market, typically the most you can get if you're buying or selling a stock is, what, 50% leverage. You can go into crazy, what I call these ETFs that are double inverse, triple inverse, or double, triple leverage. It's pretty wild what you can do, but just giving you an idea about that. But as you can see, a higher high, lower low pattern, that's where I'd look for support. The market stopped its rally against these black dashed lines, which are Bollinger Bands, an algorithm designed to keep the market within them 95% of the time. Momentum-wise, you are overbought and might be starting to roll over a bit. So I think that, you know, the Will Rogers, as I say, caution right here, probably warranted. In the meal market, you fell right back to that 18-day average finally today, and the break stopped. Now, the market's also worked its way out of being overbought. It was overbought. You can see here how the numbers were over the 70 level, and then they have worked their back under it now, and they're back to a neutral area. You still have a pattern of lower highs, lower lows. It's nullified because you're trading over the 18-day average of closes, so the bias is up while the trend is down, and momentum down but flattening right now. Soybean oil still in a bear trend. Lower highs, lower lows, under the 18-day average. Now, we are oversold with both numbers today under 20. Day before, both numbers were under 20, but not the day before, right here. Actually, it is on Friday. So Friday, you had one of the numbers 24. Then Monday, both numbers under 20. Today, both under 20. It takes 3 days in a row of being under 20, which does not happen often, for the market to change its nature and go from oversold to attempt to locking in just plain a bearish trend. If that occurs, a lot of traders will say this sideways action acts as a top formation and the market can go lower. We'll see if it develops. Don't know. In the corn market, you'll say it's under the 18-day average, and I agree. But yesterday, you stopped literally right there. So now the market is still into correction mode. Momentum is still leading price down. You have the swing line pointing with an uptrend. The bias yesterday and today, you closed both days under the 18-day average, is down, and momentum is still down. In the wheat market, the battleground pulled back from the upper Bollinger Band to the 18-day average, and there you sit. The market is still bullish. It has a pattern of higher lows and higher highs. Let's assume one bought this market, though, at 481 and a quarter, let's say. The problem is you have to have a stop. You don't have to do anything. If you have a stop under a most recent low, let's say 463 and a half, then that's a heck of a risk. So that's probably why the market needs to restructure. Sugar market. I realize people say prices can't go lower. I was hearing that up here. I cannot tell you how many of my brokers were saying it at one point. I said, guys, there's no number. We can go down and down and down in a downtrend, or up and up and up in an uptrend. Think of the stock market. Well, you just keep dropping away, and now you've got a market that, if you see, both numbers are under right now 20. They were under 20 yesterday and the day before. Not the day before. So you're embedded. Until this market gets the red line over 20, on good rallies, I expect to see sellers in this market. Coffee market fell apart up here and has just punished everybody. Now, it's 2 days in a row under the lower Bollinger Band. The way that I teach Bollinger Bands, the market has a 3% chance tomorrow of staying under the black line. So I'm expecting a bounce or sideways action as that line drops. That line will drop down tomorrow. It's the way the math is set up on the past days. And in looking at it, the resistance is 119.40. However, you're very oversold. I am not saying you can't go lower. The trend is down, the bias is down, but you are oversold. Cocoa, it's the flip-flop. You're trying to get something going to the upside out of the Bollinger Band, and the market's having a difficult time. It went yesterday over it. Today it pulled back under 27.12's the Bollinger Band at 04. That is what I mean, that when a market, all it has to do is get back to the right-hand side of it. It doesn't have to fall apart. So when I hear people always say, oh, I'm going to sell it there and try to buy it there, what about when you sold it there and it kept going up on you? That is not trend trading. Learn how to use some of these things, is my point. In the cotton, there is no trend. You've got, like cocoa, the sideways action in a market that embedded today. You have now 3 days in a row where the red and the blue are over 80. So until the red closes under 80, the market is said to be what? Have the main factor, the main tool is bullish. Close it back under 80 or get it under 80 tonight. You can fall apart on that. Then it just becomes an overbought market. Cattle on feed report later this week, evening up wouldn't surprise me in the market. Market tried a better rate today but pulled back, still in an overbought condition. You're over a 70 reading. I define that as overbought. Feeder cattle, 2 days in a row, big resistance at the upper Bollinger Band, overbought, no trend, lower low, higher high. And in the hog market, bullish trend, higher lows, higher highs. This was that break when China said they weren't going to buy hogs. They don't buy that many hogs from America. So they can put tariffs on all they want. It's not like we send them that much meat. And the market came to realize that, and I think that's important. Put tariffs on soybeans, you're going to get a different reaction in these markets. Here is the reopening as we're just getting going in the early evening. So you can see, getting a little bounce in the silver, well, rather, the copper. The silver market, well, down a little bit against the gold today, interesting. And the platinum market, well, down about 60 points on the day, but that's not even a penny. So we'll see what goes on. All the stocks correcting. And if you looked at the end of the day, they were selling off late. The impact of the crude oil API, you can see how the market is continuing a rally off of that friendly API number. Let's talk about the offering today, which is our chart of the day. And we do a lot of grain charts. So if you're looking at grains, be it rapeseed, crude oil, soybean oil markets, soybeans, all the different wheats, we do a lot of this for you. And we give you an idea where these markets might head if trends, as we define how a trend is set up, is there. So not only with the price count, you want to get the 2 PDFs from us that explain how a price count works. You can even do them yourself. We make the software available. Give us a call. You can go to our website, sign up for our free offers. We'll get hold of you and be sure to put you on this if you'd like. You can call or you can click right up here if you're watching me on YouTube. And underneath us on websites, just click away. If it says click here for Ira's free offers, we'll put this in your hands. I'm Ira Epstein. You have a great day, and I'll see you all tomorrow.